So welcome to our second quarter market review. If any of you cannot see or hear me, please do indicate that on the chat box for me, but I can see that we have it all on. Okay, so great. Kathy, good to you. Okay, so Ed, you can hear me. Good. Thank you so much, guys. All right, so forgive me for my technology inexperience here, but we got going here. So I was just saying that I got to quickly show you the slide for the compliance review. We are all, I always joke, fully licensed, bonded, and insured, and we work through Madison Avenue Securities as well as AE Wealth Management. A lot happened in the last 6 months, even the last quarter. We had rising interest rates. We had stock market declines pretty strong. We had gas prices going through the roof. I was telling you just a story about me being in the mountains and filling up my car with medium grade because premium was too expensive. I looked down and it was $5.80. I had such a shock. I had to stop immediately, and the rest of the tank was filled up with the cheapest gas, and that still was at $4.80. But I don't know how long ago you filled in your tank. Mine was yesterday. Good news is mid-grade for me is down to about $4.30. So we're starting to see a little bit of improvement, but we still have some supply chain issues and shortages, and then inflation and recession. These are the big words that we're going to talk about today. So as I talk to you about the markets, what we have this year is similar in what we had in 2008. I'm not saying it's the same market conditions. It's just a market year in which stock funds, as you can see up here, most stock funds are down 15% to about 25%. And bond funds, traditional bond funds, are down as well, 10 to 15%. The only two asset classes where we have positive returns is cash, and then the second one is commodities. And you had to be an absolute seer in the beginning of the year to transition to commodities. To make that transition so unlikely is to understand that the 10-year average return in commodities as a whole was 0.9%. The 10-year average in commodities is 0.9%. But this year is the year in which commodities is doing well. I'm just going to say to you that it is so difficult this year to find the right hiding spots, if you would, or the right investment allocation that can avoid what we are experiencing. We have done a lot of research, and I have a lot of good ideas that I've come up with and strategies that we are communicating with our clients, and I will go through that with you later during our presentation. But this is where we are, and this is what you're seeing inside of your accounts. Now, let me give perspective. If I look at the S&P 500 on the left side of the slide, since 1942 to 2002, we look at the amount of times that the stock market, the S&P, is down 5% or more in a given year. On average, about every 3 times, it happens about 3 times a year. It lasts for about 40 days. If it's 10% or more, it happens every 16 months. If it's 15% or more, it happens every 3.33 years. And if it's minus 20 or more, it's about every 5.75 years. So the S&P did dip below 20% this year so far. So this is where we are. And then the amount of time it takes to recover, or the average length, for the downturn, is about just short of a year. You can look at the Dow Jones. You'll see very similar statistics on that side as well. Now, this answers the question, hey, how often do we see minus 20? Well, not that often. And how long does it last? About a year is what we see on average length times. This is a chart here that is quite alarming to me. I'm going to describe this for you this way. Since 1930 to 2022, we researched to see how many times the markets in the first half of the year were down more than 15%. And we discovered there was 5 times. We are experiencing the 6th time at this point in time. And then we looked at what was the rest of the year, the next 6 months, what was its corresponding return, for the third and fourth quarter. And we see that in 1932, the markets went down 45%, but it responded in the next 6 months by a plus of 56. And what you'll see is that in every one of these occasions in the past, the market responded in the second half positively. Well, here we are, minus 20.6 as of the end of June. And the big question mark is, hey, how is this market going to respond? And if we look at averages, just this context, markets were down minus 24.63 average during this 5-year period of time, 6-year period of time, and came back on an average of 23.78. This is one of the charts that keeps me up a little bit at night, because there's things we would love to do, obviously, to reduce the pain, but we have to be wise and astute to see what will happen in the next 6 months. So let's talk a little bit more about that. Before I go deeper, just understand that obviously I don't see the markets. I can't predict the markets, right? You all know that. You all know that I'm not that smart. In fact, nobody is. But I wanted to give you a little bit more context. This is the average drawdown during a recessionary period of time. And these are different periods of times of recession. And the average drawdown is minus 30%. At the moment, year to date, minus 18. So there are room for further drawdown before we start seeing recovery. So let's be real about that as well. But let's take a look and see what are drivers that is giving us a little bit of more of an optimistic view of this next 6 months. The biggest driver that we see is earnings forecast for companies in the S&P 500. Just as an indication to you, this is the average earnings forecast for companies that constitutes the S&P 500. And in here, you'll see that the revenue growth, projected revenue growth from 2021 till the end of 2022 is about 10%. Then from 2022 to 2023, it's projected to be 9%. And 2023 to 2024 is projected to be 8%. This is the average earnings growth. We looked at this same statistic in the end of the first quarter, and you can see the numbers slightly adjusted, but not hugely, slightly adjusted. So we are expecting companies' earnings to continue to be positive, and companies' earnings is a big part of what drives markets. The second big factor that we've seen that lies ahead for us in the next 6 months is a midterm election. What's interesting just to look at this statistics is if you look at midterm elections and you look at, here's some dates, and you're looking at the pullback 6 months before the election, average pullback on the returns 6 months before an election. Now, people, I understand life doesn't consist of, the markets doesn't just respond to midterm elections or elections period. There's a lot of other factors, but I'm isolating this one for you. Here's the average intra-year pullback before the election took place. And this is the returns 1 year after the low date. 1 year after. And the reason I'm sharing this slide with you is because when the markets know how our government stands, then that certainty is giving confidence for markets to come back. And so if I were to look and see and share with you a positive outlook over this markets, it is that we're seeing earnings. I will summarize so far. It's earnings that is projected to continue to go, and I'll show you some more slides on that, and also more certainty of the midterm election period. We start seeing or believe or feel that there would be more of a balanced government, and the impact of that to business owners is that they just know what the known looks like, and typically that there's not major big changes that typically could come through the House or the Senate, because we have a little bit more of a balanced government. But you feel very similar to the University of Michigan's consumers that they've polled. This is a consumer sentiment index. This is how people feel in general. People feel in general very, very, very negative. This is probably one of the lowest points right here on this scale. We are hitting one of the lowest points. And if you note here, 2008 was such a time, and these low points are points just before we start seeing markets return and recover and grow substantially. And I'm just pointing out here that we are hitting a very, very low point again. So it seems a lot of times then when people are feeling at the lowest, that a lot of time you got the opposite happening in the markets. Apologize, my light just went off. I'm going to wave my light on. and see if I can come back on here. Sorry. Boy, there we go. My light came back on. All right. These recordings are always interesting. It always happens with some sort of a technology glitch, but my light's back on. All right. So let's talk a little bit about more retail sales. This is the projection, and this is where retail sales are trending. So although people are experiencing inflation, this is times where retail sales, people are still spending money like crazy. These little gray lines are times of recessions. And you can see this one right here due to COVID, but retail sales are still growing and growing strong. Another thing to look at is how much money does people have in their possession. So this is a chart that indicates the amount of money that people have in their checking account. And I have another slide here that's going to come up in a second talking a little about what people have in their money market accounts. But people are flush with cash. Here's your average amount of money, $4.53 trillion sitting in sidelines and money market funds. It just indicates that the consumer is financially healthy. And I'm going to talk a little bit more with you about that. We also see that, the consumer price index increase from the beginning of 2020 till now is 12.7%. But the average hourly earnings is up by 14.3%. So we're seeing that at least earnings is keeping up with the rate of inflation that we are dealing with at this point in time, which is probably explaining why people are still spending and why they're still buying and why retail sales are still climbing. Credit card balances is up. Yes, we can see that. The reason that is up is people are charging on their credit cards. But this indication by itself could be problematic. But when we look at the bigger picture and we look at what is the average debt versus assets? This is the debt low versus assets. And you kind of see here, there is low debt compared to assets, and it's come down pretty strong. So this is just saying that we are not experiencing an economical underground or an undercurrent, if you would, similar to what we've experienced in 2008, where people's homes were upside down and where they were very, very highly leveraged. The percentage of a person's income that is used to pay all debt is still low. It's 14%. So again, people are not over leveraging. They've learned. They're stocking up some cash. Our consumer is healthier than in other times of recessions. Then we will go over to unemployment. Our current unemployment rate is 3.6%. About 5 million people in the United States is unemployed. The big issue is the amount of growth of job growth since COVID. Huge amounts of growth, and this job growth is continuing to go on. It is not trending down. This is a large indication that companies are still hiring and desperately looking for people to hire, which indicates to you that the economical engines are still moving forward. Just another slide to show you the amount of people getting back to work. We are basically close to being fully employed to the extent just before COVID. We've added 22.8 million jobs since the bottom year in May of 2020. So we see strong job growth. We see average income for jobs increasing. We're seeing it a little bit higher than inflation, but we do see inflation, and inflation is pretty high, and it feels pretty strong. So I'll go back there and talk a little bit about inflation in a second. But if we look at the amount of job openings, there's 11.25 million of job openings, and that's roughly 2 job openings for every person looking for a job, which is creating competition, obviously driving wages up, and just showing again that businesses are hiring. Businesses are hiring. If we have a very strong recession or even a depression periods of times, you'll start seeing that these job openings come down as companies are shedding the people that they have employed. And this is another indicator for us that says that, we might be in a recession, but we have really positive underlying indicators that might make this a shallow recession, a shorter recession, or we might avoid the word recession completely this year. Folks, we will know here in the beginning of August when the numbers physically comes in on the GDP or gross domestic product numbers of production in the second quarter. Again, a recession is 2 consecutive quarters of negative GDP growth. The big reason we have inflation is this tremendous amount of money supply that was put into the system last year, right? Money galore, and this is creating inflation. And if you would, the Fed is probably behind the 8 ball in a big time way in the way or the rate at which they are increasing interest rates. The most popular polls at this point in time is that we'll see another 1% increase next week from the Fed, and many people are arguing that this is too slow. It's too slow, and they're concerned that on the other side, a lot of economists or market analysts are concerned that the Fed will overplay this by raising too much interest rates and push us into a recession as a result of it. But this is the biggest reason why we have recession. Last year, if you remember, the Fed was talking about it being transitionary, which basically would say it was going to be here and going to be gone. But the big realization is that the Fed is actually behind the 8 ball in the increasing of interest rates at this point in time. I want to show you that people's balance sheets are strong. The total amount of assets, this is the assets and net worth of households and nonprofits, net worth minus public debt of the U.S. The green line indicates that the assets is much higher than the debt, and this middle line right here creates a net worth. So again, it's not a situational circumstance where we've seen in 2008, where people didn't have enough cash, they lost their jobs, and the underlying values went down very substantially. Something that is of concern is this. There is an indicator that is called the inverse relationship between a 2-year and a 10-year Treasury yield. All that says is that a 2-year Treasury yield right now has an earnings of about 3.23%, and a 10-year bond is at about 2.1. And when these two things get in and have an inverse relationship, where actually short-term bonds pays a higher interest rate than longer-term bonds, it has been historically an indication that we are nearing a recession. This is one of the problematic indicators that is real, that is out there, that is something that we need to pay attention to. So whether we're in a recession or not, again, we will know that in about 3 weeks from now. Bigger question that a lot of our clients are asking us is, okay, Hilgard, I understand what you are saying to us here, but what are you doing about this? What have you done, and what are you continuously doing about this? Well, I will say to you, I've made a lot of notes here. I'm going to go to my notepad. We have done a lot about this downturn in the markets by our design. So we are learning also a lot about our design. So I will be real and frank with you that we are even making this year improvements to the way that we are managing money. But we've added money managers that are either dynamic or tactical. Many of you have them in your portfolios. You might remember them as names like Tactical Edge, Efficient Edge, or even Smart Beta. These are money managers that have the permission to be able to put hedges or go into larger amounts of cash positions in order to protect investors. So some of you have these portfolios you have some of these money managers in your portfolio, and some of you don't. But we have them, and if you want to continue to talk about these type of tools, we are very wide open to talk with you. Everybody's plan is unique and different. So at the fund level, our dynamic, our traditional, and our tactical money managers have made substantial changes. On our traditional money managers, this typically is our LifeWealth group portfolios, as well as our AE Alpha or ETF portfolios. What has been going on there is we've been shortening the durations on bonds. The shorter the duration on bonds, the less of an impact interest rates have. If interest rates goes up, bond prices comes down. So we've been shortening durations. We've been making quarterly allocations. Our investment committee is meeting again in about a week or so, where we will make some further tweaks. And we are moving to areas where there is less pressure or downside pressure in the markets to buffer against this growth. The dynamic money managers like Smart Beta are putting in inverse positions that actually, when the markets goes down, these goes up. and it gives some downside protection. We've seen that those returns have buffered our downturn by about 2 to 3%. And then we have tactical money managers, and some of our tactical money, there goes my light again, I apologize. But our tactical money managers have gone to larger positions of cash to protect downside. They're looking at very, very carefully to see, as the markets are kind of recovering a little bit this week, whether or not they will be entering back into the markets. Other things we've done is we are evaluating alternative asset classes. We're zeroing in on 2 different kinds of funds that will give us alternative asset class space. These are alternative or asset classes that has nothing to do with stock, or has got very little to do with stock market or bond markets. These are areas where you can go to be able to also provide, we call it negative correlation, where markets are down, these things are up. So we're evaluating and about ready to roll out some of these strategies inside portfolios. We also have built-in guarantees. Many of you have equity indexing built into your annuity contracts, life insurance policies. We've also have used structured notes. We have used structured growth notes. We're looking at beefing up our income or yield through using structured income notes. We've built out and designed a higher yield portfolio that we are releasing more of and buying more in probably the next month or 2 after we see what the Fed does with interest rates. We want to hold back a little bit before we implement because bond prices will get hurt in the meantime. But this is a portfolio that has an average income yield of about 6.5% to 7.5%. And we're using different types of sources that will produce that. In the past, it was very difficult to find those kinds of yields, but because bond prices are down so much, we're able to take advantage of some of these opportunities. As we're building income plans for our clients going forward, are in retirement or getting close to retirement, we are looking at the ratios of guaranteed income versus income that comes from yield positions. We have moved some of our equity positions to dividend-paying stock positions that's paying about a 3.5% dividend yield. We've also looked at a balanced portfolio called diversified income that is paying about a 4.5% yield. So we are preparing ourselves for looking at different types of strategies. I don't want to overload you. It's alternative asset classes, yield-oriented positions, positions that gives underlying guarantees, shortening the durations or bond durations on our portfolios is something we've done. And then we're making these allocation changes on a quarter-by-quarter basis. So it will still be a very volatile year. We anticipate volatility to continue to go on, but I am more optimistic about a positive rally in the markets than I am pessimistic over the next 6 months. So I will say to you, the tension lies in doing what is right for you as an individual client, and that is the better answer. And I would encourage you that if you have any questions about your portfolio, you haven't spoken to us in the last 3 months, 4 months, 6 months, just reach out and we can take a look at your unique specific situation and we can talk about these types of solutions. Other things I like to share always during our time together here is just a little bit of updates on what's happening at the LifeWealth group. We are adding team members. Claudia Allen joined us. She's in our operations team lead. She comes originally from Chicago, was born in Austria, and is here with her family. And we are very excited for her to help. So you will be talking to Claudia a lot when we're helping you implement different types of portfolios and strategies. And we are loving the fact that we are promoting from within. Brad Malloy is moving into our portfolio admin position, and Joe Continelli is moving into our financial planning department with Hilton. And we are very excited about these types of moves that these guys are doing. Shay Kute got a professional designation called a Certified Divorce Financial Analyst. We love to help people in 2 areas of pain, where there is a divorce or where somebody has lost a spouse. We're passionate about helping people rebuild their financial futures, and Shay went further to get some really good education on that. We will continue to communicate with you, so please stay in tune with our market update videos. We get something fun coming, an update from the captain's chair. I got a special guest that's going to be with me on giving you these updates. And we have found that just communicating with you and explaining what's going on and giving the right context is really the best way to be able to navigate and make great decisions together. We also have a few events coming up that I want to quickly make you aware of. On Thursday, September 22nd, we have an event coming up where we're discussing advanced tax planning strategies. It will be again hosted here in our meeting room here, our office, and will be catered with a dinner and drinks. And this is helping people think through taxes in the future as well, maybe some today, but also taxes in the future. And it has a lot also to do with strategies to avoid capital gains taxes. So we'll talk more about that. Anticipation is that probably we'll see taxes be on the rise. So it'd be important and smart to look at this. Again, something we talk a lot about is in down markets is not a bad idea to take a look at Roth conversions. So this is part of what we were going to be covering during this workshop. Then we are working also with business owners, and we're going to be doing a workshop on October 5, again here at our local office, strategies to help business owner build maximum value so that they can sell their companies and they can retire successfully. There's 6 of these strategies we'll cover. If any of you are business owners or you know business owners, please invite them to this workshop. This is very informative, very, very helpful for people to know this. It's important to focus on these things at least 5 or 6 years before you want to sell your company. Then I'm going to do in a panel. We're going to have an advisory panel, CPA, an attorney. I'm working on a business insurance person and myself coming together again. We've done this event in the past. We're planning on November 1 to do this, where you can come and you can ask questions of all these 4 professionals relative to your wealth. It's very, very informative, very helpful, and it's interactive. And you'll see the planning team that we use on a day-by-day basis to help our clients. Again, if you know of anybody who's selling their business or want to sell their business, we are helping more and more clients transition from their businesses. I'm working on 3 of these transitions right now as I speak. There's a designation I got called Certified Exit Planner, and we enjoy helping folks in this area. Then for the ladies, something fun. Many of you have come to this event. This is our LifeWealth Women from Wonder to Wisdom. They meet once a month. It's the first Thursday at 6 p.m. It's right here in our office again. Topics coming up is helping professional women successfully transition from business to retirement. That's going to be August 4th, and September 1 is again around tax planning. Then I want to thank you. We will be having our ambassador events coming up next month. Our Ambassadors Club is a great club that we have initiated where we reward our clients who introduce us to other families. Times like this is where people have a lot of questions. And frankly, I think a lot of financial advisors are doing nothing and just letting the markets ride. And people have questions about what can be done. I'd encourage you to take this recording and send it on to friends of yours that maybe if you had this discussion with. And if those families become clients of ours, we love to induct you into our Ambassadors Club and our Ambassadors Elite Club. The difference is just whether it's one family that you introduce or 2 families. We have exclusive events where we celebrate with our ambassadors and thank them for their introductions. And we thank you again for your trust and confidence and introductions to others. I want to remind you, although it's been a tough 6 months and there's a lot of uncertainty probably ahead of us as well, today I'm communicating more positive than I'm communicating negative with you. Just want you to remember to enjoy the journey. Please enjoy the journey and let this stuff not put you down. We are here every day. We are monitoring positions. We are monitoring different ideas, and we invite the opportunity to visit with you on a one-on-one basis. Because planning is so unique, we do most of our conversations one-on-one, either through Zoom or in physical meetings, where we can take a look at your underlying portfolios. So that concludes my time. I would like to, my goal was to be done in 35 minutes. I'm right on time. And so I'm going to open up the chat area so that you can ask questions. And I'm happy then to answer some of these questions for you. Let me see. I got sound sorted out. All right. Yes. So I don't see any specific questions here, just a lot of thank yous and that you are with us during this time. I appreciate you very, very much. I would say that a lot of questions we get asked is, Hilgard, when is it going to get better? That is to be seen, but I am positive that we'll see some improvements towards the end of the year. So it's the combination of different strategies that gives our clients the level of protection and confidence that is tied to a plan that is real specific to when you need your income and when you need your capital to grow. Those are the best ways for us to plan and to strategize with investment strategies as well as with tax strategies. And so with that, and my light going on for the third time, I thank you again for your time here together. I got to sort that light out next time. But I'm also recording here from our new studios here in our local office. So it's great to be with you. I wish all of you a great rest of the weekend. And thank you for your time.